Hi. Thank you, guys. Thank you, everyone. Really excited to be here today. Bear with me 1 second. Okay, so today it's about how to navigate an ecosystem that is becoming increasingly complex as we're advancing. But before we do that, myself, I've been in the industry working within venture capital, working with some amazing companies for the last 10 years. And I've created this because I'm seeing a few things happening in our ecosystem. Europe is moving into the fast lane. What I mean by this is that we're starting to see more and more pressure on founders to deliver the type of growth that has not been possible until very recently. One of the reasons why that is happening is because we're seeing this complexity of new products to the market, products that are of a financial nature, and they're being created to enable companies to get from one stage to the next in record time. But that means that as a founder, you're finding it a lot more complex to actually deliver the type of growth that you've envisaged. And we have a disconnect between companies and founders that are very experienced or coming from the US, that are very acquainted with some of these very useful concepts and very useful products, and what we're seeing here in Europe, and even more so in Central and Eastern Europe. And as we go on, these are quite important ecosystems for our venture capital space and innovation. So today, really, I wanted to kind of go through some very useful insights, be able to share some concepts that are highly intuitive in a way that you can make best use of, and most importantly, have fun with. As founders, there's a lot of pressure to know a lot more than you have done before. So we're going to cover some of the core solutions within finance that scale-ups and startups alike can utilize to hyper growth your businesses. So those are the first element that I'm going to cover. Then I'm going to put it all back together and show you guys how it works. Look at real companies that have been able to transition from one stage to the next. And finally, I'm just going to focus on some of those key areas so that as a founder, you're navigating this ecosystem in a way that enables you to achieve your goal, whether that is to go from 100,000 to 1 million of revenue, or from 1 to 5 million, and potentially shift your timelines. So we're going to start with one important element. Why are we finding it, hard to manage this? Because finance is not intuitive. It actually is counterintuitive. It means that the things that you think are all right are really not all right, or they're not workable. So picking the wrong type of product or wrong approach or wrong technique in growing a scale-up means that you're actually at risk of potentially not delivering your business goals. Or if I move on forward, you could potentially fail to align your cash flows. Using the wrong type of finance solutions means that you have to tap into your cash reserves or go back to your investors, or actually have to raise very quickly to alleviate pressures from the lenders that you've been collaborating with. And as we'll see, these are not conventional banks. These are funds from the US and from all the parts of the world rushing to Europe to provide various different solutions that are not very well understood by founders. So moving forward, what it could go wrong, the next thing that could potentially go wrong if you're not paying attention is that you could find it very difficult to predict and project how much it costs you. So you could be doing a very important exercise and take a particular product but not understand how it's priced, end up paying a lot more for that capital because you just couldn't navigate the ecosystem in a way that is very unique to you. Or even worse, you could potentially have too much management. For early stage companies, some of the products can be awfully demanding in the types of information or controls that a financial institution or a fund could possibly demand of you. These are funds that provide finance products, not necessarily equity. Finance products are very different because they're repayable. So too much management means that you're spending too much time monitoring and producing information rather than actually building your business. So coming to the last one, I think it's very important to realize that we're living in a very complex environment, and you could end up in a situation where you might not be able to manage the demands, or you have not considered the scope of the solution that you're putting in place. So you could very quickly go through a very challenging exercise of restructuring or actually dealing with default and insolvency. And this is so important because so many more early stage founders from their first few months are accessing now finance products. And we'll see some of them. So let's look at the first one. Everybody in this ecosystem has probably heard of venture debt. It's a product that has made a huge growth potential here in Europe. It's more and more popular, especially with VC-backed companies beyond Series A. Then we have revenue-based lenders. We've seen so many of them. They're amazing companies, both from Europe and the US, addressing our market. And this is a very important type of product that you guys should understand because it has a purpose. And if you don't use it for the right purpose, it can have a detrimental impact. And we'll see how. And finally, there are a number of products that are called revolving credit. And I'm going to tell you the story of what this really means and where this product kind of originated and what it can do for your company. So we're going to go through all these three, and then we're going to put it together and look at how some of the most sophisticated companies in the US and here are actually managing to grow using this type of solution alongside equity. And if you're able to master these tools and mix and match at the right times, you could be taking your company on a different growth pathway. So it's not necessarily an option to know about them. You have to be able to use them if you want to be in a high growth company and you want to be leading it in a highly competitive marketplace. And Europe is becoming one of those environments, as US is, where more and more companies that are coming to the market have to be able to scale rapidly in a way that historically, when I started in this ecosystem 10 years ago, you didn't have to. Now there's a substantial amount of pressure for founders. So we're going to start to navigate this in a very simple way, in a way that it makes a lot of sense so that you guys can use the tools to understand some of the mechanics and remove some of the complexities. If you understand the simple elements, then you will be very, very capable of adding complexity on top of it, and most importantly, adapt it to your own business. So let's start with the first one. This is venture debt. Venture debt is an amazing solution. It has been created like 5 decades ago in Silicon Valley, and it's, by any other means, it's a term loan. It's basically a bit of money that you're receiving, and then you have to pay back over an amount of years. What is unique about it is that it's always attached to a VC funding round. It's very popular with companies beyond Series A. It's potentially becoming more popular within the seed space, but here in Europe, it's one of those solutions that is making inroads in the UK, in Germany, in Denmark, in the Nordics, is going to start to trickle down, and basically everybody in the next few years is going to have access to this type of products in various different formats. So I'm going to show you how it works very simplistically. So let's say you have a 10 million round. Usually this type of solution will be able to advance you around 30% of your equity round. So let's say you have 3 million that is coming in. So the arrow going up is that from day one, you've signed a contract, it's really good, and now you have 3 extra million to grow your business. How does it work? So what do you do afterwards? Usually this type of product will have a period where you're paying no interest, or you potentially pay just the interest and no principal. Principal is the amount of that 3 million that you have to pay back. So that could be somewhere between 3 months. It could be all the way to 12 months. I've been very privileged to work for one of the largest organizations that provide this, Silicon Valley Bank, and potentially one of the companies that coined the sort of structure of this product in the market many, many decades ago. So as a company, you probably want to grow very fast beyond your Series A. You're probably going to consider this, or if not, your investor is. So you now have 12 months, you're paying nothing, and then you have to pay back what you've taken. And this is really called the amortization period. So I know it's a boring terminology, but basically it's the period where you pay back what you've borrowed. It's similar to you and I paying back a loan that we might have taken to buy a car or buy a house. So it's no difference in that respect. But most importantly, you have to be careful, because vast majority of companies in the venture space are not profitable. So you're going to have to ensure that you're going to be in a much stronger position to cater for these payments. So even when you're projecting, when you're thinking about your future and your company, you have to take in consideration how important this is going to be and how impactful this kind of misalignment could potentially be for your company. So maybe if you're a SaaS company already with $1 million of revenue, it's going to work well. It's going to give you the power to go out there and hire 20 more salespeople, develop your product, be able to do amazing things with it. And as you scale, you're going to be able to access more and more capital at Series B and C. So that 2-3 million that you would have accessed in your Series A will transform into 20-50 million by your Series B and C. So that's a lot of capital that you could access. But if you're not necessarily delivering the revenues after that first period of not paying anything or paying just the interest, it can be quite affecting, quite challenging for you as a business. So coming to the finer details, venture debt is really a term loan over 4 years usually. It has the characteristic that usually the finance institution or the fund is looking at your investors. So they will go to your VC and they will absolutely get an understanding how much capital they're going to be putting into your company, how they're going to help you if you're slow, if you have a period of slow growth, you can't deliver. So it's very, very triangular between yourself, your VC investor, and of course the fund or the institution that gives you this massive amount of capital. But most importantly, you have to be careful. So before you rush into anything or you start planning anything, consider some of the details. This is a very unique product and very risky to some extent. So it's going to be very expensive. It can have anywhere between 8 and 18% interest. This is across quite a number of providers in our market, all the way from the UK, France, Germany to kind of Eastern Europe, some dedicated funds for this market. The next one is that you actually pay for arrangements. So you pay fees to actually get into this transaction. You have legal costs, which are quite substantial because every single deal is unique in its own right. So this is venture debt. It's a product that has immense impact. And actually in the US, it's such a common practice to use this that whenever they announce the round, they will put the equity and the venture debt together, and that is what they will be actually announcing. So when you see a Series B of 100 million or 120 million, there's absolutely 100% of the time an element of venture debt, especially when it's backed by one of the leading VCs. So be aware that there's some implication. These are very simple to kind of understand. They're very powerful in the sense that if you deploy that capital, you could get from 1 or 2 million to 5 or 10 million in 18 months instead of maybe 3 years or 4 years. So it has an immense power. And that's why it's one of my favorite, because it can unlock the type of growth that very few other traditional banking products or finance products in the market ever would. In terms of the next one, revenue-based lending, this has been, perhaps the poster child of our last 18 months. Everywhere you go, you probably have been able to access it. There's some amazing companies, even some here in Poland, and they're amazingly useful for our ecosystem because they provide type of short-term finance that is very useful for companies. They provide it very early on. So when you have 10,000 or even less in some cases of revenue, monthly revenues, you can start to introduce this into your company and unlock that incremental growth when your product is new, when you have nothing. You don't have a community, you don't have key investors, you don't have the top VCs backing you. This is the sort of product that can help navigate you from one stage to the next. It's not perfect, but nothing ever is, not in finance at least. So how does it work? Let's say that I need 100,000. I have maybe 50,000 of revenue a month, and now I'm taking 100,000. One of the things that you will notice is that it has a fixed fee. It's very simple to access. It's very simple to kind of understand how you pay it back. It's revenue-based, so what does that mean? You pay a percentage of your revenue. So if your revenue varies, what you pay varies until you get to the point where you pay back what you've borrowed. So let's take 100,000 of loan. You're in a very good position. You've applied to one of the many providers in the market. I'm not going to name them. It's been an amazing experience. It's been very easy. You maybe have access to the money the same day. So that's really cool. And now you have to pay back 100,000 plus the fee. It could be anywhere between 6%, that flat fee, or 12%, depending on the provider. And you have to pay between, it's 106,000 and 112,000. So you're already in a very good position. You have 100,000 to deploy in your business. And that's cool. You can do a lot when you're very tiny as a business with that sort of money. You don't have to fundraise. You don't have to go for that very painful exercise of pitching to tens of, if not hundreds of VCs and investors. Accessing this means that you're able to take advantage of something that very few people are going to tell you: seasonality, timing, momentum, that is very rare in our industry. And as a founder, you have to be very fine-tuned into what works for your business. So yes, that's it. So from day one, you've taken this capital, you have it there, but you have to pay back that plus the flat fee. And you do this out of your revenue. So let's say month one, I have to pay back 25%. So I have my revenue, 25% goes away. I have the next month, 25% of my monthly revenues go away, the following month, and so on. But there's a trick here, and something that, unless you're already in finance or building a fintech, so you know these things inside out, finance and the way in which this is underwritten means that you are going to pay back quite quickly. So that's why it's short term, because you are going to potentially pay it back in the first 3 to 4 months. That is how the system works. You have to be a growth company. You have to have a few months of record of how your company has performed, and that would be the foundation upon which one of the providers is going to give you the money. So when you're considering this, there will be something that you are probably not going to be able to assess very clearly from day one. If you're growing, you're going to pay it back very quickly. So as a form of capital, it becomes extremely expensive if you're very successful and growing very fast. But if you're not, then it becomes potentially less burdensome, because if your revenues are dropping for a few months, then you have that flexibility. And that's why it's so founder-friendly. It doesn't put pressure on you to commit to a certain way of paying it back. But it does have some elements of uncertainty, and that is really around pricing. And this is something that I see every single day in my line of work, working with companies, bringing new solutions to the market, and of course investing. And the fact that that flat fee is not really an interest rate, is not really a very good definition of how much that capital is going to cost you. So once you have accessed it once, you're not going to be able to access it again. You have to reapply. If the situation of your business has changed dramatically for the worse, then you're not going to be able to access it. So it's not a given that you're going to be able to take after a few months another one, and after a few months another one of those. And that's the difficulty. So if you're thinking of this as a product, it's very useful. It has an amazing purpose. I'll see where it fits in the journey of a company. But it has some kind of some issues. It lacks transparency a little bit on the pricing, because if you want to be able to access it again and again and again, you actually are going to pay somewhere between, I would say, somewhere between kind of 18 and 40% for that capital. So could there be something better that you could use? Depending on the purpose, depending on your business, depending how you're deploying it, it could be an amazing tool, or potentially it could tap into a very difficult position, because you're not going to be able to service your operational cost. So that's potentially the sort of caveat. If you're thinking about this, model it, plan it, introduce it into your model, think about how that growth will impact. Think about if you're not able to deliver the growth on the revenue side as you imagine. There are things that happen that are out of our control, even when we have amazing teams and great products. So think about all of those elements, because they're going to be very useful for you. In terms of how much you can actually access, the industry is quite set up now, even in most of Europe. But for a few countries where, unfortunately, there are no providers, and potentially this is a huge opportunity for so many more entrants to this market. This is a huge market. Right now, it's somewhere around 80 billion in Europe. So just if you're thinking this is just a blip, it's not. It's a huge, huge market, and it's just growing because more and more businesses in tech and innovation and outside it are forced into a digital realm to become digital first. And for that reason, this becomes an important type of product, in addition to anything else that is provided by traditional banking systems. So this is the second product, which means that we're all the way to the third one, and one that is very exciting. So this is really revolving credit. You all have it, I have it, everybody that is of adult age probably has a credit card or an overdraft. That is revolving credit. That is its perhaps more technical term. It's not very difficult. We make it complicated because of the terminology, but I can give you an example. Before I left Silicon Valley Bank, I was very privileged to work with an amazing company that had an amazing consumer product. They were kind of making 80 million or so of revenue. And one of the things that they really wanted was to be able to have like a credit line that they could tap in for various different things, like anywhere from marketing to inventory to working capital. And because they were a very good company, very profitable, they were able to access lines of 10, 15, 20 million. So they were able to grow in a way that a traditional company right now before reaching profitability would not be able to attain or even dream of. So very large companies and established companies have been using this sort of products for generations. And they have always been available for very profitable, very established businesses. But there's something changing in our ecosystem. There's something that has started to change in the US with the introduction of new generation of products for high growth companies. And this is really where kind of my story comes in, because I'm building and bringing with my colleagues within Velocity a product that is meant to basically lower the threshold. So bringing something that profitable large businesses have been using for a generation to founders that really need a lot more flexibility and need something that is scalable. There is a unique element about this. And I'll tell you what, some companies in the US, like companies like Capitalist, Silicon Valley Bank, and many others have been very much positioning this for 20 years now. So if you were in the US, you probably would have had access to something that is very, suitable for your business, to how you have your, how you make money, to your cash cycle. So how, the way in which you sell as a business, and kind of molds onto your business. So it enables you to establish an amazing baseline and continue to grow in a way that you haven't been able with any of the other products. Why is this particularly interesting? Because it helps you get from a point, a very early stage point, to that Series A and B in record time, and it does that because it has a different function. So with some of the other products, you're applying, you're getting a loan, you're paying it back. The end, you want more money, you apply again for another loan. It's a problem, isn't it? Because it takes time. You might not be in the same position with your business. It might be very, very challenging for you to get something that is very competitive. And if the market changes, potentially you're not going to be able to access it. So this is different because it's a credit line. What it means is you can continue, similar to your credit card, continue to use it, continue to pay back on a specific way that works for your business, and continue to draw down again. And if your business is doing really well, you can increase it. So this is the beautiful part of it. Let's say you have a $500,000 line. You're doing exceptionally well. You're 100,000 pounds a month in revenue. In this market, you could probably access to some of the very few providers, maybe up to 5 times your monthly revenue. So now you have a line of $500,000. I mean, how many companies are able to get $500,000 from a traditional bank? None. There are only very few providers in the market, but this is the growing segment, and it's going to become very, very persuasive for a lot of companies. You're getting this $500,000, and you know what? The best part of it is like your credit card. If you don't use it, you don't pay. This is exactly what it does. So let's say month 1, you only need a little bit of. I think we're stuck. Can somebody help? Yep, it's stuck. Here we go. Yeah. Okay, we resolved it. Does it work again? Okay, so let's go again. So let's say month 1, you only want like 20,000 for your digital marketing. You're able to achieve it. And the fact that this product is very flexible, you just kind of decide when you want to pay back. So you could pay back in 3 months or in 12 months, but you still have 480,000 left to use. So the following month, you can still continue to draw down. And the following month after that, you continue to draw down, which means that as a business, you're able to do things ahead of the curve, ahead of your plan, because you've used the right product and you've aligned it with your cash cycle. And very few founders that I've met, but for experienced one, have really got the grasp of it. If you use the right product, you have an ability to scale in a way that you've never even imagined. And there are many examples out there. Gone are the days when it takes 12 months to get from 0 to $1 million. There are companies that are getting to 5, 20, and even over 100 million nowadays. So the benchmark is getting higher and higher and higher, and you're not going to get there by equity alone. So what is particularly unique about this? It's not a term loan. It's like a credit card. You're able to utilize it. You're able to deploy it when you need it most. Have you found that seasonality or that segment of your year, or the momentum when you need to put more money into something and you just don't have it? Just imagine that you did. What would that look like? Could you get those 10,000 extra users? Absolutely. So that's the best part about this solution, is that it enables you to take advantage of something that happens in the market that is very positive for your business. And if you utilize it well, you're able to get ahead of the competition and maybe even navigate very competitive ecosystems and maybe get first to the post with something, raise capital a lot quicker from investors. So yes, this is really the three kind of new products that are coming to our market. They're growing, they're making inroads. It was 8 billion last year. It's potentially over 80 billion of the market that needs to be carved off. So very, very soon, you're not going to think about whether I'm going to go to a major bank or the other one. You're going to think about what solution is best for me and which providers can give me that solution, because founders are going to have to get very acquainted with this new way of scaling, because they're going to be pressured if they want to get venture capital, funding. So let's put the pieces together and think about, is this something new? Are we just thinking theoretically? Absolutely not. There have been quite a number of studies showing that all successful exits in the US market, VC-backed, have used 50-50. So the story to success is 50% equity and 50% this type of product. And it has been in the US for decades. It's just here we've been having some problems because the product were not existent. They didn't come in the market until very recently. And founders are very confused. Most of the founders that I speak with on a daily basis have an issue on not understanding how to deploy the right thing at the right time. And that's one of the reasons and my mission to kind of resolve by doing this over and over again until as many founders as possible have got the knowledge. So how do you kind of navigate this ecosystem? You have to start with a purpose. If you don't know where you want to take your business, it's going to be very hard for anyone to advise you on finance or growth on that matter, or on equity. So if you don't know how you want to scale your business, if you don't know the purpose of that capital, it's going to be very challenging. So you have to look within first. But once you find that purpose, it's going to become very, very simple. So let's take some practical examples. I'm going to give you here an amazing company. Let's say it's a real company, but obviously that doesn't have a name. So a real company that made an exit. And how did they do it? What did it took? So let's say that early stage, they started like everybody else. They bootstrapped, they created the product themselves, technical product. They were able to use revenue-based lenders to kind of get to the next stage. They were starting with a small kind of facility. They ended up growing to about $500,000. And then they were, perfect for Series A, because they didn't need to do intermediary rounds. They didn't need to dilute more than they had to. And that's the beautiful part about using finance for the right purposes, like acquire users, digital marketing. That is what you use this type of products for. So now they've done Series A. And guess what? Because they were in the US, they were able to have with their Series A okay, it's a few years older, up to 2 million of venture debt. What would 1 or 2 million additional to every company raising Series A would mean in kind of revenue growth and enterprise growth? Quite substantial. So this type of company was able to scale quite rapidly to the next level, which is Series B. And before they even got there, they, when they reached Series B, they were able to get quite a lot for kind of credit lines so that they were able to advance some of the capital and make it even easier to Series C. So you already see that very early stage, there's already a product in a company that has been successful. At Series A, they're getting 2 extra million. By Series C, they have 20 extra million. Now, just imagine how much can a business grow if they had 20 extra million on top of an equity round. It's quite substantial. So before you know it, these are the success stories that actually navigate quite quickly from seed, 18 months later running their Series B, and then before you know it, it's a 5-year success. It's a $1 billion company or $10 billion company. This particular company is now worth over 400 million. But this is the point here. This is what success takes for a company that wants to get there very quickly. And it's the reality of what we have to deal with in our ecosystem. So knowing how to put the 3 kind of blocks together is very, very important for you as founders. So I'm going to fast forward a little bit. Let's take an e-commerce company. E-commerce is very interesting because throughout lockdown, something massive has happened. It happened with all of us. We bought 80% more online for obvious reasons. We were stuck at home. But what that meant is that 18 billion of business moved into a different realm, competing for your audience on platforms, on social media, on your phone, on any device you can think of, because you were stuck at home. So that meant that all of a sudden you had to deploy in a very different way. So that is the product that we created. And some of the companies in our portfolio have been able to achieve quite a lot of growth because of the products that we've created. So thinking about real examples, this is what happens, whether you're a B2B company and you're searching for the right solution, or whether you're a B2C company driven by what's happening in the sort of ecosystem and the shift in consumer preferences. But fundamentally, you're able to shift the growth and the timeline with finance. Finance has a role and a very important one to play. So without going into the very technical, there are just a few things that I want every founder to kind of have at the back of their mind. Don't think about the details. Your advisors, your finance directors, your finance consultants will know them. But think about it this way. Whenever you're taking something, you have to think, what is that product going to do to my business, or what is it going to prevent me from doing? So I'm going to start with the first one. Vast majority of lenders, like venture debt, serious funds that are going to deploy a massive amount of capital in you, they're probably going to take what we call security. So basically, a right to control your business and to be able to prevent you from taking more finance or even raising more money so that their interest is protected. So if you're successful, they're going to get their capital back a lot sooner. So that's one of the things. Do be careful when you're going out there searching for the right solution. Ask the questions, what do I have to do as a business? Are you going to restrict me in any way from taking maybe another loan or maybe taking finance? Ask somebody else. Go to their FAQs, read the agreements yourself. But if they're very complex, there are plenty of sources of advice there. So always be mindful. Not reading these sort of things can have a detrimental impact because you're not going to be able to bring capital quick enough in your company. And I've seen so many cases where actually it's been very distressing for them. So always be careful. Security, debentures, those are very technical words, but fundamentally it means that they have a right over your company. They have a way of restricting you from doing certain things with your business. Then think about your kind of personal guarantees, personal assets. Many lenders in the space will probably want to figure out quite a number of different elements. So they're probably going to ask you as a founder to potentially guarantee the performance of a finance or a bit, or a particular loan. So this is very important. If you're seeing this, definitely speak with your lawyers, speak with a lot of people. There are a number of different providers out there that are doing it in a very convoluted way. So very important to keep your eye on. There are quite a number of different elements like, can you cover your operational expenses? This is OpEx. Can you, navigate? Do you have enough kind of value from every customer? So let's say you want to do a marketing campaign, but you're not going to recover enough of that in revenue. Is it really profitable? Are you at the stage when you can afford to do marketing or marketing activities without being profitable? Ask yourself all of that before you deploy finance capital into any campaign. Without that exercise, it's going to be very difficult to kind of navigate the ecosystem and pay it back and actually grow your company. And as we've seen, if used correctly for the right purposes, you can fast forward, move your timeline. If not used correctly, it can be quite detrimental and probably the difference between kind of passing by, maybe getting to the next funding round, and failure, outright failure. So definitely worth getting your head around, worth taking some of the intuitive building blocks, and most importantly, getting to the next stage as quickly as you can, using the right solutions for you. So that's all for me. Thank you, guys.
Thanks.
I know that nobody probably saw the whole presentation, but if you have any questions, more than happy to. This. Hybrid events are really complicated, right? Oh my. Oh, bless. Definitely.
See you there. Thank you. Okay, so any questions? Any questions? So we are live. So
Yeah, go for it. Yeah, go for it. Yeah.
I'm sorry I couldn't attend the entire presentation.
No worries.
I might ask something that was actually discussed earlier.
Yeah, go for it.
You are working as an advisor to those processes.
No, I actually, I think that my profile was probably announced in the very beginning. I am bringing a product to the market. So one of these products, I'm bringing something completely new to the market very soon. And I'm also working for the European Commission, and I'm developing a number of educational programs to actually address some of these issues because they're really, really endemic. And the further I move from kind of UK, where I spend most of my time, to Central and Eastern Europe, I find that the knowledge becomes kind of less and less relevant. And actually the product, if you're sitting in kind of Romania, Hungary, Bulgaria, there are going to be very limited tools that you have. While if you're in Austria or Germany, you pretty much have everything. Yeah. You can grow your company in so many different ways. So that's what I'm doing. That's my day job. Doing a lot. So I'm very intimately involved in structuring and understanding and creating solutions for founders and for the market.
Right. Yeah. Thanks a lot for clarifying that.
Yeah.
So, yeah, I would agree that knowledge level is probably dropping.
Yes.
So that's
yes.
why people like you to do that.
Well, you know what? I've just seen so many companies in, clients and in the US through when I was at Silicon Valley Bank, and some of the companies that I've worked historically making the transition and being able to almost turbocharge their growth in a way that if I was sitting, let's say, in Bucharest, I wouldn't even know how. I'm very doubtful that that knowledge permeates, so that a founder from kind of planning stage is thinking, I'm going to get, the first 10,000, 20,000 of revenue with the sort of early stage pre-seed seed capital, and then I'm going to use some of these products to help me kind of unlock growth where I can, because those tools are not present in the market. And the knowledge is not there, or they're very conventional banking products. So yeah, we're on a mission. Look, guys, I absolutely can guarantee this market is just absolutely ridiculously big. It's like 80 billion as of last year. It's just growing, and it's growing at a rate that is eye-watering. So I think in 2 years' time, we're going to sit here, and we're going to have very similar as in the US, 200, 300 different providers. So it's not even going to be a question of whether this is going to happen or not. I think it's just going to be this kind of boom all of a sudden. And founders are going to realize that, oh, by the way, this exists. What does it do? And the education needs to be there before that point, because it's coming. There are probably 50 funds in the US landing right now as we speak in Europe. So that market is changing considerably. US has about 300 different providers of different, whatever imaginable product you can think of, it already exists. And that's the beauty of it. Yeah.
Absolutely.
Amazing. Well, guys, I think we're done. Are we done? Yeah.